Now, I want to connect to the Economist article with a case on the same problem. It's a very nice case study from Harvard Business School. It's called Deutsche Bank Discussing the Equity Risk Premium. Yeah, so if you want to read the case, I just zoom in to the important things, which is they prepare a presentation to discuss with asset managers something related to the risk premium. So first it's a fixed income group, and they talk to equity managers, and they want to talk about that you should not over-predict equity risk premium. You will learn in the portfolio management setup next week why the risk premium is a key determinant for deciding how much to invest into equity and how much not. Therefore, if the premium is high for equity, I would invest more into equity, less in fixed income. Yeah, so this fixed income group has an incentive, basically. First, to talk about it, and second, to lower the predictions of risk premium. Whether they do it in the case, I don't know, just some background. And here, they are saying an ongoing discussion that the research group had held over the past few years with the clients was that the investor community should not overstate the risk premium for equity when comparing bonds to equity. The ERP, so equity risk premium, was traditionally defined as the expected return on the stock market in excess of the return on the risk-free bond. Obtaining a reasonable estimate for the risk premium was important since managers often rely on that as a guide for allocation. Okay, so I just said that. Now we zoom in to, I come back to this one. So I want to zoom in to their presentation. Or maybe not. Okay, let's follow the plan. Okay, so I come back to Economist, I come back to the Harvard case, but I want to give you a third evidence. And that is a regression table that has been run. It's like a textbook-like example. And you see what has been done here. The return on equity from T to T plus K, and K can vary from 1 year to 4 years. So again, like in the Economist article, yeah, just K was 10 in their case. And that gets regressed on the dividend yield at time T. So it's the same exercise that the Economist did, just here it's more scientific. Yeah? Why scientific? Because we get the standard errors, so we could compute whether or not something is significant. So you see here the definition of the dividend yield. It's the annual dividends divided by the stock price. And how do we read such a dividend regression table? You see here the coefficients. So these are our betas. In the Economist article, we saw they were positive, because the higher the dividend yield, the higher the realized return. We also see here they are significant, they are positive. We see coefficients are rising as the forecast horizon rises. And the T statistic is also significant. So my rule of thumb cutoff is 3, standard deviation of 3, or let's say T-stat of 3. So we see for horizons, let's be generous, from 1 year to 2 to 4 years, it's significant. So yes, indeed, there's a positive relationship, which the Economist did talk about. In terms of variance explained, so 20% of the variance in 4-year realized returns can be explained by the dividend yield. And then the regression has been run also in terms of excess returns. So you subtract the risk-free rate from the realized equity return, and you see there is no big difference. Coefficients roughly the same, T-statistic a bit smaller, but it's all in the same intervals. So message is here that indeed the dividend yield is a predictor for equity returns. The second message is you see that the longer the forecast horizon, the more can you predict. It's also very typical in finance. Said differently, if you try to predict short-term movements, that's very difficult. And therefore you will need diversification to diversify your risks, what we talk about in portfolio allocation. Okay, now I want to show you also another regression table. That's from a paper, Cliff Asness. He has a PhD, Finance Chicago, and he opened his own fund, AQR, Applied Quant Research is the name. It's very successful. If you want to read something from industry, I recommend they have a blog and the like, read on their page. It's high quality. Yeah, they also write research papers in the Journal of Finance, so top A. I've mentioned previously there are funds where the bosses kind of are like previous professors or the like. That this is one of these funds. And yeah, just an anecdote, during the financial crisis they also didn't perform well, yeah, because the market goes down, they go down. And it's something you will also learn in the course, why this is the case. And then I met a guy, he was my student, he was from engineering, but he was older already. And he worked for a sovereign wealth fund in South Korea. And we talked like 2009, 2010 about these things. And then he said, yeah, the fund is so well known and has such a high reputation that part of your fund you want to invest with such a fund. Yeah? So I think the message is kind of, like for me, this was one of the early funds who really tried to connect with research, tried to bring research into their investment and also talk about it, make it transparent. So they are successful with that strategy, although I haven't checked over the last few years. Now, he had a paper, 2003, so it's dated, but still, we are in the bachelor's class, we can learn something from it. So he's taking, and it's a published paper, so he takes the 10-year realized return on the S&P, that's the index in the US, so it's like the Economist article again, and he's now regressing that on the earnings yield. And the earnings yield is defined as the earnings within a year divided by the current price. So it's like the dividend yield, but it's the earnings yield, slightly different. So he runs this regression for different time periods. So again, you see, good scientific work, you want to be robust. Yeah? You just don't want to pick only one period, but you want to see how results change, since this is not a big data environment. And here you see, I chose this one, 1955, 2001. So that's the post-war period. So you see also the beta here is positive, 1.2. So if the earnings yield goes up by 1%, 10-year returns tend to go up by 1.2% over the next 10 years. The T statistic is 3, so we don't have information here how it's computed, robust, non-robust, let's just ignore it. But it looks significant. The R-square looks really high, in-sample R-square 30%. So same paper, different analysis. Now he tries to regress, or he does it. He's regressing 1-year returns. It's called real return, so he also subtracts inflation of it, but I don't think that's a major thing. And now he is predicting 1-year returns, and you see although it's still positive, it's not significant. So it's the second study you see to convince you short-term predictability most likely not there. Longer-term predictability most likely there. Yeah. I highlight again, if you can't predict what prices are doing, it will be optimal just to diversify your risks. And how to diversify, we talk about that next class. Now what we learned from these two tables is both the earnings yield as well as the dividend yield are predictors and somewhat in the same range in terms of R-square and in terms of the beta. The Economist article chooses the dividend yield. They could have chosen the earnings yield as well. And now we go back to the case, and the case study now has a dilemma. That's what these case studies are all about. They give a dilemma, you think through it, you feel the dilemma, and then your learning happens because you are really in the problem. And I just provide you the summary to save time. The problem is that they've been computing the dividend, the equity risk premium using the dividend yield and using the earnings yield. And they both come to different conclusions. And now they wonder if they go to the client, which dividend yield forecast should they present? Shall they present both, or shall they present, since they have the incentive to warn from overstating? It seems within the case to me that they are inclined to work with the lower risk premium. So let's go through the calculation here. They take the dividend yield plus expected dividend growth. This is what Economist says. It's a truism. I will prove it next slide. For now, let's take it as given. Then you get the equity yield. They call it the real equity yield because we think about dividend yield is a real number, because if there's inflation and dividends, it's also in the price. Yeah? So dividend yield ratios are usually real. Then real dividend growth is also real. So it's like the nominal GDP growth minus inflation. So they have 4.94%. This is like the expected return on equity according to the dividend discount model. And then you subtract the risk-free rate. I'm not sure how you've done that in the bachelor Grundlagenstudium. Here the case is highlighting we should subtract the long-term risk-free rate, which I think is correct. Yeah? Because it's the long-term equity return, so you want to subtract the long-term risk-free rates. It's like a long-term bond yield. And they get to a solution of 2.47%. Now, if they work with the earnings yield approach, and I've shown you in the regression that this is a valid method, there the models, the calculus says you simply take earnings within the year, divide by current price, that's the earnings yield. This gives you the expected equity return. So the first question is, why is the dividend not in here? We go through the math, but for now let's assume this is correct, which it is, and then we subtract the same risk-free rate, 2.47. So you see the dilemma in the case is that there are two well-accepted approaches for getting the risk premium. Yeah? If I go for dinner and someone just asks me, coming from the left, what's your forecast on the dividend risk premium? That's exactly what I do. Yeah? I go, dividend yield is this, plus expected growth, minus risk-free rate. So it's very common, and it's a very common first shot. And here you see the solution is different. So anyone has an opinion on which risk premium should they work with in their presentation? Good. Then let's continue further. I come back to the question. Yeah? I just want to add some more research. What I want to do next is I want to bring the dividend yield and the earnings yield into one frame so that we can better think about what does it really represent. And here, who has not heard about the Gordon growth model? Not heard? Who did BWL Grundlagen? Okay, but Professor Ruckes, he talks about that. But usually students forget, because you learn a lot in this course. So this is absolutely, it's expected. It's not an outlier, right? Therefore I say a fresh look. So, but I wanted to know. So now it's a very fresh look. So I don't make any connections back to earlier classes. Now Gordon, he was a professor we are talking about many, many decades ago. And he's been asking the question how to find the price of a dividend stream. Right? If I just offer you 100 euros, next year another 100, and then another 100, and I ask you, what are you willing to pay for that? Of course you say zero, nothing. I say, okay, of course, he wants to pay nothing. But then I ask someone else. Right? So in some point in time, if I ask just very many people, I most likely get a fair price. But what is that fair price? So the idea is that you are writing down all the cash flows you're going to get in the future, and then you divide by some discount rate. Why discount rate? Because money I get today is worth more than money I get next year. Right? In addition, here, for simplification, we get rid of the expectation operator. Now, in more complicated frameworks, we would also value using that, but we would incorporate expectations to include the expected dividend. So you can think about that. RE here is our return on equity. So we will discount for just the time value of money. That's the risk-free rate. As time passes, money today is worth more than money tomorrow. This is just the time value. But then we also have a risk premium in it. Because if these dividend movements are random, which they are in reality, and starting next week we learn if they're also systematic, meaning I cannot hedge these variations, then I want a risk premium for that. That will be an equilibrium outcome. So let's rephrase. We find the price of a dividend stream by adding up all the dividend streams and discounting them by the proper discount rate, which takes the timing here into account. Now, I love this formula very much because I know how to make it more complicated, and it gives me great intuition. For example, if I want to value what's the value of a house, and I don't mean a house I want to live in privately, but I mean a house, real estate I want to rent out. Yeah? Then the way I value that, and that's how any other pro is doing it, is exactly the same formula. You think about what's the rental income I'm going to get, and then what is the discount rate? How much interest do I have to pay to the bank, and do I charge any type of risk premium to it? And then you get basically what are you willing to pay for it. And maybe if you, because real estate next to crypto is another thing that the young generation is interested in. So in case you are, if not, then you should. You've heard in German Mietrendite. It's a very important metric for real estate valuation. And Mietrendite is like the dividend yield. It's how much rent do you get per year divided by what you pay for the house. And the point is, if you have dividends which are constant, and I think about real estate rather constant, yeah, so it's a conservative view which I have, and I usually also think about real estate is going to last forever. Then I can solve this infinite sum, and it boils down to the price today, let's say, of this real estate object is nothing else than the annual rent I get divided by the return on equity, or my refinancing rate, basically. Yeah? So that is the most simplistic one, because I'm assuming that the dividends D1, D2, D3 are all the same. Now, the next more realistic assumption, this is what Gordon then did, is he says, let's assume that dividends are expected to grow by constant, GC. Yeah, so like with real estate, let's say I assume the rent is increasing by 2% per year, kind of like inflation. Now, if you do that, you still have an infinite sum. So you see you have here the expected growth rate divided by the return, 1 plus the return you expect, define that to be x. So now you simply have an infinite sum on x, and the solution of the infinite sum is 1 divided by 1 minus x minus 1, if x is smaller than 1. Now, x smaller than 1 means your discount rate must be larger than the growth rate of dividends, which is intuitive, because otherwise the price would be infinity, yeah? Which is a good thing. If I would like to buy something which is worth infinite. But as an academic, when we build models, that is ruled out. So we are working here with the assumption that the growth rate needs to be always smaller than the discount rate. Yeah? Otherwise, it's kind of a no-brainer to buy the thing everyone wants to buy, price goes to infinity. Okay, now if you do that, constant growth rate, and we also have the constant return on equity, then you can simplify that, and that you can double check that at home. It's a geometric series which then converges to this one here. So the price today is today's dividend times 1 plus the growth rate. So this will be next year's dividend, expected dividend. And then you divide by the spread of return on equity minus the growth rate. And now we work with this formula, and we are solving for return on equity. And then you get exactly what the economists did talk about. That it is a truism, yeah? Because there's nothing wrong with this formula here. It might be a bit simplistic. I leave expectations out, I have no time variation and the like, but it doesn't matter. The overall intuition comes across that the expected return, so the return on equity which is priced into the project, coincides under these golden growth assumptions to the dividend yield plus expected growth in the dividend stream. So yes, indeed, it is a truism. And yes, indeed, the Economist wrote a good article being so bullish on this formula and their empirical study, that there should be a positive relationship between the dividend yield and, that's why we also say it's the long-term expected return, yeah? Because we do not have here a time index on return on equity. We cannot solve for that. Therefore, all we know is, on average, the return will look like what we have here. And again, think back about the regressions. Roughly 20% of the variation in these long-term returns are explained by the dividend yield. Yeah? So it's really a good proxy here. So therefore, for sure, the dividend yield is something the Deutsche Bank could use in their presentation, and this would be the solution given current market numbers in the case. Now I'm curious about how to verify or how to put support onto this model here, because in the case it's a bit explained qualitatively, but even if I read it, I'm like, I don't know, better just write it down using some equations. So that's what I've done here. So what one can show that the earnings yield model, which is heavily used in industry, is a specialized Gordon growth model. So what are the special things here? The first thing is the growth rate GC does coincide with what we call a sustainable dividend growth rate. There's more to come on that term. Now, if we look at the formula here, the sustainable growth rate is basically defined to be the growth in your earnings or in your dividends that is going to happen if you don't issue any new equity, and whatever you do with the money inside the firm is going to give you the return on equity. So it's an equilibrium thinking, which in reality it doesn't hold. But maybe it holds, for sure it holds approximately, but that's a theory thing here, not a big theory. But the idea is kind of, I can either take my earnings, my dividends, let's say I have earnings, I give it to you guys, you're the shareholders, and with these earnings, you can now, for example, buy the shares, or you give it back to me, and I just build a new plant, and the plant will also make a return. And the assumption is, whatever we do, we are earning the return on equity on it. Yeah? So in that sense, you see dividend yield model is a bit more general. Earnings yield model needs these additional assumptions. But if you work with these assumptions, then you can rewrite the sustainable growth rate as the return on equity. This is what you're going to earn on your earnings. Because if I'm the firm and I keep my earnings, then with that earnings, I'm going to earn return on equity. So therefore, if you multiply return on equity by B, and B is the earnings retention rate. Yeah? So how much of your earnings, of the firm's earnings, stay in the firm? If it's 50%, it's 50%, and then on these 50%, the firm is doing something which returns the return on equity. But we see in a moment the B will cancel out, so it doesn't matter. Yeah? And in the case they talk about 50-50, we don't need that. Now what we do now is we start with the dividend yield model here, where the price in zero, the value, equals, we had here D1, the dividend. And the dividend is nothing else than the earnings of the firm, 1 minus the earnings retention rate. Yeah? So 1 minus B is like the payout ratio, dividend payout ratio. So therefore that comes in the numerator, and in the denominator we had return on equity, which we keep here, and then we had minus the growth rate, and now we use the sustainable growth rate, so BROE. So you can factor out return on equity, so you have 1 minus B in the denominator. Therefore, you see, indeed, the value of a project should equal the earnings I get divided by return on equity. Or solve for return on equity, and you see that return on equity should be the earnings yield, indeed. Yeah? So let's connect back. In research, academia, and industry, you see, both are applied. Therefore, I've been providing you 2 regression tables. That's for the earnings yield, that's for the dividend yield. And they all depend on each other using that value stream which we discount, or the dividend stream that we discount. And now in the case study, we have this dilemma. We have that, maybe it's not a dilemma because you say it's all measurement error. I don't know. But in the case, the numbers we see are Gordon growth model gives us a 2.47 equity premium. And in the earnings yield model, it's 0.94. We will see that when we go to portfolio management, you will allocate significantly more to equity and less to bonds if the premium here is roughly 3 times higher. Yeah? So therefore, in the case they ask, what's the difference? And for us, the question is, Again, it's the science of financial data. It's about what's the reason for the difference. Anyone has a view? What could be reasons? Now, the first reason before I studied the numbers, I always think about that's a simplified modeling here. There's no God-given law why this solution should be the same, right? So I'm okay with having differences. The next thing I do is I want to know where do they get the data from, yeah? The science of financial data. Because I know that financial data, you can play around with that to make the point. And they want to make a point to have a low risk premium. So therefore, I try to check carefully on their assumptions which they're using here. Now, I have a table from the case, and if you read the case, they adjust the equity premium, they adjust the price-earnings ratio. So I want to talk about this table here. Now, the first thing is, for finance data, IBIS is a very well-known survey. It basically surveys academics and empirical researchers in industry. Yeah? But that's usually like the academics at the top US universities and then the Merrill Lynch, JP Morgan's, New York, London kind of. And they ask them, what's your prediction on earnings, on dividends for different firms? They collect that and they have a business model of then selling in an anonymous code what these different people have said. We are using that in research as well. Prior to 2008, we were not, but we learned that we want to use that. These are good forecasts. Like single investors forecast is not good, but if you take the median, it's pretty good. And this is what they also use in the case here. Yeah? So they use the average or the median price earnings. That's the inverse of the earnings yield. So this is 19.3. And then inside the case, they are making adjustments. Here they have different correction factors. So they make a correction factor for historically the IBIS overpredicts actual values, they argue, né? And then they are making an adjustment, so they increase 19.3 by 12%. And then they talk about other things. Now, I found curious when I look at that their computation here for 0.94 works with an earnings yield of 3.4. So the price earnings ratio is around 30. This is this number here. Yeah? But if I were to use the original value, unadjusted, then my earnings yield would be 1 divided by 19. So I would be at 2.7%. And no, I would be at 1 over 20, it's roughly 5%, minus the risk-free rate, 2.7. So what we learn from that is, if I use the raw estimates for the earnings yield, I'm coming up with 2.7% risk premium, which is very similar to the Golden Growth model. This is pretty cool because, again, it's not God-given that the two models should be the same. Of course, we can work through these derivations as I did, but maybe that's the academic in me, yeah, kind of being fascinated that the numbers are pretty close. Now, for data science, we also learn something. If you are serious about data science, you need to make sure you understand the data someone is using, because this guy presents you the results. But what you want to know is what's the input. And when you read through the case, it's well written, the argumentation of why they make all of these adjustments. And I don't want to talk pro or contra these adjustments. Right? But what I do is I give you a footnote. So again, you see the academic. We are going through footnotes. I found a footnote in the same paper I presented before with the earnings yield prediction, yeah, from Cliff Asness. And he says, I do not promote the PE ratio versus other reasonable measures like the dividend yield. So again, there's a confirmation. You can use both in industry. But I rather only promote to use raw versions of the valuation measure. Yeah? Although he talks about interest rate and inflation adjustments, my point is in general. Whenever someone adjusts the data, that is a warning flag. a big warning flag. Yeah? And you need to understand why he's doing it or she, and what's the implication on results. And then kind of my point for the case study is that if they want to go with the 0.94 prediction and they have a knowledgeable audience in the presentation, they are basically, the discussion will just be on these adjustment factors. And I wouldn't go this route, right? The route I would go is, we have two classical approaches, PE, dividend yield. We use these unadjusted numbers. We get 2.7, 2.5, so let's take the average. So let's say 2.6% is the equity premium. Yeah? Okay, this was my fresh take on valuation. Is there any question on valuation? Anything you wanted to know about valuation? Now would be a good chance to talk about it. Otherwise, go again through the slides and through the case. I think it nails it pretty well. Now what I want to do for the remaining time is I want to get started with the Python. Yeah, so it's again high level. I mean, most of you, most likely all, love Python. So these slides are from a time where Python was very new. We started using Python maybe in 2015. R and MATLAB was still predominant. So that's why also some of the timings are dated, but it's still accurate. So first of all, Python is very prominent. But the kind of the gold standard in finance is C++ and Python together. I see that in our research when I went from Columbia to KIT. I heard AQR when they recruited at Columbia University that they were also saying, if you know Python and C++, if you know Python really well and the quant, very good. If you know C++ in addition, that's like exceptional. Yeah? And I can see in our research it's kind of the same. All the data manipulation we do is done in Python. But if we, for example, Ralph, he works on enormously big data. And there are many, before you can do machine learning, you need to process the data and get the data where you want it to be, right? So, and then he is working with C under the hood of Python. There are packages like Cython, which already wraps the Python code automatically into C. We had other projects on the PhD in our research level, not with the students, just with us, where valuation routines, expectation computation routines, all computed in C++. It's just very fast. But in terms of data handling again, Python. So I tend to think about Python as like the conductor. And you have different solo instruments. And in finance, if speed matters, and it matters for high frequency, it matters for market making, right? It matters for these event studies, not the study itself, but if you want to trade on these very little nanoseconds and the like, of course speed matters. That is usually computed in C++. Okay, so why not everything in C++? Its development time is lower, difficult to maintain because fewer people learn C++. But the ones who know it and can apply it into a field where it matters, they have a premium on the career path. Okay. I'm also currently refreshing my C++, so there was a professor and he made a point on a different graph, but it's all the same basically, it's rather stationary. And he said, there is a C family, it's C, C++, and C#. If you add them all together, which I never done because I was so focused on the C++, but of course the syntax is very similar. So if you see that kind of, if you pick any number, let's say US job market, it's roughly, let's say, 50,000 times 3, it's 150,000, yeah? So you get above Python. So I think the message is just Python and C++ together or separate, but this is the gold star or the North Star, as I said. In our course, we will use Python. You can do a lot of great things with Python, and also all development is done in Python. And think about our course as being development. Our entire curriculum is kind of prototyping, development, and the like. Good. Now, assuming you haven't used Python, so I remember when Python came out, because in 2013, 12, not many people use Python, but I heard AQR is using Python, so I got interested in it. And for example, it's interesting that there is a data analysis library, it's called Pandas, and the data library was heavily developed by AQR itself, which is completely fascinating, isn't it? Because we all use Pandas, and then you ask, most likely Stanford or someone to develop? No, it was a hedge fund. It's like the DeepSeek thing, or what's the name, the Chinese? It's the same thing, right? Because that's why I'm saying finance is the best field. You can, of course, teach finance badly, or you can do trivial things, but if you really do finance, what it is, it's a field of engineering with economics coming in. It's just a great field. And show me a Python person who doesn't use pandas. We had projects where then the student came back and said, but this was master thesis towards the PhD, and he said, I can't use pandas anymore because the data is too big. Yeah, this can also happen. But for everything you see in our problem sets, it's big data, but still pandas works. And we used to say a pandas data frame is your new Excel sheet. Yeah, that's why sometimes maybe people in industry say pandas is like Excel, I mean Python. But if you come from MATLAB, from R, you just call upon a matrix element by element. And so you always need to know what's the timing, because you don't save the timing, you just save the entries. So the nice thing about Python pandas is really you have a column with the date, if the original data has a date column. This is really nice. For example, there has been now research code posted from a top publication, and a PhD student looked at it, and he said it's coded still in MATLAB. And he said they according to the paper, they run a predictive regression, t+1 on t. But he said if you go through their code, they flip the index. I haven't checked it's true or not, but just I think it's a good anecdote, because in MATLAB this can happen, or in R, yeah? Because you just shift the indices and you can't really double check unless you look carefully. While in Python you just really double check whether this is the proper date that you want to regress something on. You also have variable names, which is pretty nice. Yeah? So you know also about data science now, financial data science, use meaningful names. Yeah? So this is the close of T-bill. So it will mean T-bill is the treasury bill, and closing so would be the value end of day. So most likely it's an interest rate. We don't yet know it's in percent or not. That's something the data needs to be documented. Yeah? But for now we don't see it. But we see it's daily data, 3%. So most likely this is in percent annualized. Okay. Then we have close MSFT. That seems to be the closing price of Microsoft. Yeah, it's just so many years ago that it cost then €2.50 or $2.50. We have the close of the S&P 500. And then we have the T-bill daily. So that's most likely the divide by percent. But that's not my point here. Yeah? My point is just we have an Excel sheet, basically, pandas. Then we have some nuns. That's okay, we just get rid of them in a minute. But the pandas will be your data frame, where you store your data. Now, here's an example of how regressions can be run. And there are different packages of running regressions. Yeah? So you have a package you like, you just do it. One more thing, I didn't say that for the problem set. It's okay if you work with GPT on that, right? Because the point is just, we want to make things realistic. We can never ever control whether you do it or not, and in industry, you would also use it. Yeah? So, of course, we are rather progressive on AI and using AI. But if you make a presentation, you have to make a write-up. If the write-up doesn't read well, or if it's wrong, then you pay for it and not GPT. That's of course, yeah. For example, with this Kalman filtering, I checked 2 weeks ago, I gave GPT, it gave a beautiful solution. Yeah. So I think it can also be great learning. I also use that if I refresh my C++, I have all these debugging errors, I give it to GPT, I say, what's the point? I don't say anything, I just give it. It knows automatically what I want, right? And then it helps me. And then I almost also like, I would like to write it like that and that, please check or the like, yeah. So therefore, we are progressive. Use it as a training tool. It's not a curse. It's a useful tool. Okay, now having said that, there's one way to run a regression. You can load in a stats models package, and it has an OLS function. Yeah, everything which is standard in literature is implemented in Python. Same holds for machine learning. If you do frontier research, then you often have to code yourself. But otherwise, if you're just the user of something, you can just use all these packages. And you see it's pretty intuitive. Yeah? We are here having here parentheses, then there's a dot fit. That must mean fit and OLS regression. Next thing we have here is the data. So we see the data is stored in a data frame. So this will be pandas data frame. We always call it _df, so it's pandas. And we called it stocks. So most likely all of our data is in stocks. So this would be this data here. And then you see we can simply call on the name of the column, like msft, xreturn. It's not yet here. Doch, yes, it is here. Yeah, so Python pandas would then just know we want to regress that column here on what I show you in a minute, on this column here. msft, no, excess return. Oh, this is here, excess return. S&P 500 excess return, let's double check. Yeah, here, yeah. So 2 classes from now, you will call this a CAPM regression. For now, it's just a regression where we regress the Microsoft return T on T, so it's a mapping. It's not predictive, it's a map on the S&P 500 excess return. Why is that a good idea? That comes up in the course. Then you get here, so that will be your results. So results, maybe I call it like an object, although I'm not 100% sure object is the proper name. I just called it that. And then object has a method, summary, so results.summary, now I get a regression table. So I see I regressed Microsoft excess return, and the column name, I used OLS, which I used here. The method is least squares. We will do MLE in the tutorial because you can use both, but MLE is useful for other applications we have. You see we did run the regression 2017 at 10:04. Number of observations. We do not use robust covariance matrix, so it's just asymptotic standard errors. We have the R-square here, 34%. And then if you're interested, like AIC, BIC, but that's not our concern here, just about using the Python. But again, it's also about reading a regression table, so that's a fourth regression table tonight or today. So you see now you have nice names on your variables, because it's just taken from what you give in. And the intercept is intercept, so we see there's a coefficient, 1.2, the standard error, 0.3, the t-statistic is 35. So it's highly significant. Yeah? That's just a motivation of why the theory we talk about CAPM in 2 weeks from now is a good theory, because you see it's not complete rubbish. 35 is a high t-stat. If we are also refreshing statistics a bit, we know that the true value is not 1.24. If I were to change my sample, the data is different. But what I can say is, with 95% probability, the true value is in this range here. And the higher the t-statistic, the lower the standard error, the more narrow is that range. Yeah, so you should always watch out for these confidence bounds and or the t-statistics when you do empirical work. Okay, now, and then we have here a bit what's the skewness on the error, so it's rather 0, what's the kurtosis, condition number and the like. It's not my business right now, so I would move on. Just want to highlight there are other packages you can use for running these regressions. Good. Now I want to show you could also use sklearn, for example. It's another library, and I just highlight here a few snippets I took from somewhere. So you see in Python we would read in the libraries we want to work with. So we would import pandas. You can call it whatever you want to call it, but call it PD. That's what 90% of the world is doing. Then you import NumPy. That's for numerical calculations. Like if you want to compute log returns or the absolute value of something, that is in the NumPy package. And then now the sklearn has specific other measures we might be interested in. Like that's a snippet from a cross-validation exercise. So you would want to compute the mean squared error, not by hand, but use sklearn. Maybe you want to run a rich regression and run a cross-validation on these hyperparameters, then either do it by hand, but hardly anyone is doing that nowadays. So you just can read in from sklearn, there's a package for it, and then understand the package, what it does. Yeah, for example, here's a code snippet which which runs a lasso regression, and then it uses 5-fold cross-validation. It's not my topic here. I just want to mention it's a scientific method, and for that there's a package out there in sklearn. So here you specify the cross-validation, how many should be used, and otherwise it's a very similar fit type of architecture, and then you specify what are your X variables in the training. Or you specify the XY split. Yeah? If you use a package, make sure you understand the package. Here I don't teach the package. Just want to show you running regressions in Python. There are different ways to do it, and it's all pretty straightforward. Now, what about machine learning? There are two big libraries which are prominent in Python, which also make why Python is so popular in machine learning, because the libraries are so good, and they are. The first TensorFlow is from Google, so just by name it must be good. Yeah? But it's Google Brain who used that and then made it public. So of course that's high quality. Interestingly, someone knows TensorFlow is written in which language itself? I mean, you use it as Python, but under the hood. Whenever these questions come, it's always C++. Yeah? So I thought you know, so good that I asked. So also the same with MATLAB. Right? All these matrix libraries under the hood, it's C++. Because C++ is, as they say, you can't get closer to the machine than in C++. But the front end or the interface to the user should be more user-friendly, and then you have, like, say, like TensorFlow or Python. But that's why these languages also go well with each other. That's why, like, Python can have a library like a Python where the code gets translated into C, because that's the mother language basically underneath. Okay. It's also popular in finance, of course, because you get the libraries. Now, one thing for the science of financial data, these machine learning approaches are developed for environments where predictability is very high. High signal to noise is the jargon in science. Yeah? If signal is high relative to noise, it means information is high relative to noise. And if information is high, you can predict, because you're predicting information. But in finance, we have a low signal to noise environment. And here you see, again, also research-based teaching. So I come here with a modern research paper. It was the first machine learning paper in finance, 2020, written by Brian Kelly and co-authors. Brian Kelly is my age. He's professor in Yale. He did a PhD with the Garch Nobel Prize winner, Bob Engel at NYU. And he is, for 5 years already now, also head of AI for AQR. So again, you see, right? That's what I mean. In the exciting finance, everything moves so close, but it must be very good. And so he had done the first, together with another professor from statistics and another one. They have used off-the-shelf machine learning methods and tested that on equity returns. And I plugged in a copy-paste of the slide, of the table, because I was arguing finance is low signal to noise. And I want to give you intuition. What is low signal to noise? Now, they are looking at all the stocks in the US on a monthly basis. And they use, for example, OLS regression, or here OLS3. This will be our pharma-French regression, kind of, what I will do online in class 3 weeks ago. And then they use other methods like elastic net, trees, boosted trees, and neural networks. Now, it's early in the game, so I just focus on what's really important. It's low signal to noise. Now, here they are plotting the monthly out of sample R square. And you see, if you are predicting the next month's return using a regression, the R square is negative. So the model is rubbish. Yeah, this is objectively speaking. Now, if you use 3 factors, and here are the factors: size, book market, momentum. What's that? In 3 weeks from now, we have a section on it. Yeah, but these are the 3 very well-known factors to capture systematic risk. And then the out of sample R square is at 0.16 in percent. This is 0.16%. So it's not even 1%. It's not even a 0.5% predictability. Yeah. This is low signal to noise. Low signal to noise, high noise to signal. Yeah. It's just very, very difficult to predict what's going to happen here for monthly stock prices. And I want to highlight that because we have been running several projects with computer scientists over the past years in our masters, and we tell them, but I never showed them. And then we give them running code and they do something with it. And then after 3 weeks, they are like, we've plotted the expected returns. There's something wrong in the code because it moves very differently than the realized returns. This is a very important anecdote for you guys, right? Because we are not used to working in such environments. And therefore, I think all types of lectures you are listening to, or that you will listen to in the future, they are high signal to noise environments. Right? So their out of sample R square should move towards at least 85% north. Yeah, so this is a fraction. Now the next thing I liked, and the paper didn't talk about that, is that it did talk about that, but in a footnote. Is that significantly different? Because if I use a neural network here, they use 3 layers. We have neural network in the course, so for now just take it as a buzzword, classical standard neural net. The R square goes up, the paper says, massively by factor 3, but statistically speaking, it's not significant, the difference. Yeah? Again, the science of financial data. Finance is academic, and it's industry, and it's marketing a little bit. And we need to dissect all of that. So you see, if you use machine learning, let's say neural net, you can predict more, but the data was not sufficient to tell us that it's significantly better. And even if we argue it is better, it would still be a 0.4% R square, which is it's a moment to cry, basically, right? Because you cannot predict well, but they then later show, even with that amount of predictability, your resulting portfolios look better than if you were not to do it. So I think the positive message here is that being able to improve the predictability a little bit can help you to make more return on your investments. Yeah, I think this is something which you should take away with. Especially since we are combining that with reinforcement learning at the end. We are not statisticians here. Our game is not to make a good forecast. It's part of it, but we are from finance, so we also want to make good decisions. And decisions is about risk management and portfolio management. And then maybe later the CEO's business model, but this is far, far in the future. Okay, so here's the citation, academically relevant, Gu, Kelly, Chu, 2020, Review of Financial Studies. I mentioned that today in the morning, I want to do it once again. The low signal to noise does not mean that the data is rubbish, because sometimes I say data is noisy, and the more experience you have in machine learning, the more noisy for you is, oh, the sensor is broken, I should work on that. But here it's 3 arguments I've been collecting of why it is something like an equilibrium outcome that finance will always be low signal to noise when it comes to predicting prices. Reason 1 is efficient markets. Yeah? If these terms are not so clear after lecture, also use GPT. Yeah? They are pretty good. The 4.0 version, if not, check Wikipedia or some investment book, I can give recommendations. Yeah? So I'm not explicit. It's not an investments course class, which Ulrich Homburg professor is also teaching. But I think you get it from here. Efficient markets. Who knows what efficient market? Or you all know, but who's brave enough to say?
Is the hypothesis that all the information are in the price?
Right. Every information is in the price. So let's say I'm the CEO of Apple. And I say, you guys, you are the first. Our revenues went up by 50%. What you guys should be doing is you open your trading platform and you're buying Apple. Because it's not yet in the price. Because I revealed it to you the first time. But now I don't think about you guys, I think about you having billions of dollars to invest with. And this is what you should think about, who drives prices. If these guys now start to buy Apple, someone else comes in now and says, why is Apple up 10%? And you know the information. The information was, Apple released just a second ago, or a minute ago, revenue went up by 30%. Yeah? So efficient market is something very natural in finance. Again, science, I give you a bit practical anecdotes. It took some years for me to understand that what you want to do as an investor is you want to go into markets which are not efficient. I give you that as, you know. Because if markets are efficient, what you're earning is this average risk premium there, which is okay. But as a hedge fund, you want to get alpha. In 2-3 weeks, we come to that. Yeah? But you want to do something abnormal. And for that, if markets are efficient, it's just not possible. Yeah? What are inefficient markets? Now, when crypto got into the market, it was inefficient. Yeah? Why is something inefficient? There are just a few small traders trading that thing. Ask yourself, is BlackRock trading that thing? Or AQR and the like? If they don't, maybe it's inefficient. If they do, most likely it's efficient. Yeah? Real estate is still inefficient. Yeah, kind of. Okay, so the next thing is, let's assume now we do the machine learning and we find the pattern which was unknown before. So we know if a signal happens, like if the CEO drinks from a hot tea, that seems to predict the stock is going up. Now, if that is valid, we trade on it. So the next time you see him taking the bottle, you already see the price jump up. And it will be so fast that you already just, when I reach for it, people will do the trades. Because the probability of he wants the tea is pretty high in that moment. So therefore, prices already will jump before you see me doing the pattern, and therefore the pattern disappeared. That is what I mentioned, the other machine learning professor mentioned right from the get-go, right from the beginning. This is what we have to live with. And there's finance research showing how much time does it take for a predictable pattern to disappear. And I think the half-life, I forgot, we should check if we care for that, but they distinguished, is it just a working paper or is it published? So you can think about if something is published, the impact disappears by half immediately. If it's okay. We will talk 3 weeks ago, 3 weeks in the future. If something goes away, it means it was not an equilibrium outcome. It was just an inefficiency, which now got discovered and it disappears. If something is an equilibrium outcome, it remains. And we will talk about what is equilibrium outcome. Yeah, it's related to systematic risk. We come to that. So the point is, and the third point is, the price today, think about your valuation equation. It's all the dividends in the future over discount rate, and it's an expectation in front of it. So if I have the expectation that dividends go up, the price goes up. Therefore, if the big investors like BlackRock have these expectations, they're already priced in. That converges with efficient markets. But the realized price will be different, because the realized price depends then on tomorrow's expectation of future dividends. And they will be different, because between today and tomorrow, there's new information coming in. Yeah. What did Trump write? Do we now have the tariffs? Yes. What's the value of it? Do we laugh about it, or are we really scared about it? You know, there's information we don't have today of what these values will be tomorrow. We could try to predict, but still we don't have them. So therefore, finance prices are notoriously difficult to predict. But it makes it exciting because it's a very dynamic environment. So whenever you find something, you should trade on it massively, exploit it, and then find something else. Good. Now, also, if you want to go with big data, really big, we don't do that in this course, but it's a first day course today. There's a Spark, Apache Spark is a big data environment, which is very useful for working with big data. And Python and Spark, they have a connection. So there's a library like PySpark. And it's another example of, again, Python being the conductor. Instead of you calling directly this Apache Spark, someone already framed that into a library, and this is then the PySpark. Here's just some code. I did plot here a few snippets to show how pandas in PySpark, how you can jump from one to the other, and run regressions one or the other. And it's really a great feature of Python that since it has so many libraries, you can jump between libraries. Like here, I think we load CSV. In this example, it will be loaded with PySparks. Again, it's not our avenue here, but just to show. And then you are taking the data, and there's a method to this object. It's called toPandas. So then it translates it into a pandas data frame. So it's really, if you do Python for data work, you are really good in terms of you are putting your investments on the right infrastructure. Yeah, and then you can here use pandas to compute the mean. We will also do that directly with calling the column name. You can do that. Then here you can use Spark again, read in the data frame from pandas, and then work with the Spark libraries to do something. Yeah, so it's pretty nice for a user. And you also can run regressions. Typically, you see also when you write code, you should write code to be easily understood by an outside person, at least on a high level, what you are doing. Yeah, so without us knowing what Sparks is, we know here it runs a regression, a linear regression. We know what are the features. So these are our x variables. We know what are the labels. So that's our y variable, model.fit. Also, everyone understands what that means. So you should also aim for really writing well-readable code. Code which is not well-readable, it's basically rubbish. Because no one spends time then to go through a code, not in industry, not in research. So that's an effort. This is part of the value of writing code. And you will see in the problem sets kind of what we think is good code, and double check with AI, and then I think you develop your own style. Now, what's also interesting, it will be interesting for one of the very last classes. You can also connect PyTorch and TensorFlow, which is for setting up neural networks. You could think about. You could also include an optimization problem right into a layer of a neural net. This becomes handy when we talk about this robust reinforcement learning, because they include this Markowitz portfolio approach, what we talk about next week, into their neural network. And I forgot who wrote the package, but here it says Agrawal 2019, so it's also pretty recent. Now he writes a paper, gets published, he gives the code out, and it shows the user how to include such a optimization layer into a neural net. And from then on, you can just use it, cite it properly, and we will see one application where this is done. And the chance is good that in your last problem set, you would also work with that. Good. So there are many libraries. I can't talk about all of them, but once you have a problem, you just Google or ask AI, and they make suggestions. The most important ones we used in the past was pandas. That's kind of your Excel sheet, the data frame. Then in stats models, you have OLS and what you need. In NumPy, you have numerical calculations. In SciPy, you have different scientific libraries. like optimization, which we will also need next week. And then if you want to do Bayesian statistic, there's a PyMC, you have plotting, you have the scikit for machine learning approaches, and the Jupyter notebooks can also be seen as a library, which is a mixture of LaTeX and Python. Good. For textual analysis, you have many libraries and the like, right? And it's basically, since the libraries are so good and there's so much support for it, Python keeps booming. Good. Today, in the tutorium, in the Python focus session, Masa and Adelan, they will help you to introduce you into the Python infrastructure if you haven't done it. I'm sure you can also do it on your own, but we offer full service here. So therefore, I jump over that. And I now talk about some first steps in Python. So think about you are interested in understanding what the price of something is going to do. And that's our mindset right now. Yeah, we get the price from somewhere. Here it's already in a file. It's also on Ilias. And then we do some very first, I don't want to call it basic, but I like the word. So we do some very basic, but I mean early in the process. We would do some basic things about, like, look at the data. Huh? Is there anything which is obviously wrong? Did I load in everything correctly? Is the data Gaussian or not? Maybe it doesn't matter for you, but the more we go into the course, it might matter. And because, yeah, let's just keep it as a statement. And you just try to get a feeling for the data. That's what you should do with any type of data project. Even like one of the students mentioned, he likes to do energy, but it's the same thing. You know, whenever you get a data set, you want to look at the data set. Yeah, so we call that here a basic explorative analysis. Again, the code is complete, but if you're new to Python, get yourself the data, which I have on Ilias, and just redo the calculus here. And otherwise, just enjoy my introduction here. So what we will do is, the goal is here, we have the S&P 500 saved as a CSV. For example, you go to Yahoo Finance, there you download the price data. And now we want to just look at the data and look what the returns look like. So what we do is we are importing here pandas to have a data frame. We import NumPy because we will use later the log return. So the log function is in NumPy. And then we want to plot. So we use a matplotlib library. Now what we do is then PD, so that's our pandas dot read CSV. Then we give in the name of our CSV file. And we are also saying that there is a column there, date, which it shall use as dates. If you make sp500.head, yeah, that's now our object here, .head is a method. You see we are getting the first 5 elements of what we did read in. Yeah, so we see column 1 are the indices, which later we get rid of. Column 2 is the date. And we have the year, the month. If I look at that, next thing I check immediately is the frequency. So it's daily returns. That's what I see from there. And we see the price. So most likely that will be US dollar. Yeah? Of course, I need to be sure. But right now, it's enough like that because the probability is pretty high. Why should it be anything different? And for the introduction, it doesn't matter. Why doesn't it matter? Because we are computing returns. So the first selection you make is which type of return? Geometric, arithmetic, logarithmic. It all doesn't matter to a first approximation. Right? Now, in math finance, we like to work with log returns. There are different reasons for that. For now, I just tell you we use log returns here. And the way we do it in Python would be, we go to our S&P 500 object, our data frame, and now we are adding a new column to it, and we call it log red. Yeah? Different students, different analysts use different names, but at least it should be clear what it is. And if you read log red, it's not with an A like red, but it's red like return. So most likely it's a log return. Yeah? Better than check the formula. And I see here, you use the NumPy package. It's a library. It has the log as a method in the library. And you simply give in the column of S&P 500. So now you have the log price. You see also good documentation here. Whenever you write code in our class, but make it general for everything in your life, make sure there's a manual to it, which also displays the formulas. Students like just to say, hey, let me show you the code. This takes far too much time. It's not efficient, and it's low signal to noise, because it's very difficult to identify an error, right? But if you see the formula here, and suddenly someone uses ST minus 2, right, that's a problem. It's good for me to know. So it's like if you do good coding, like in the C++ refresher I take, they're also saying, or I read that, I think GPT might have told me, if you want the program to crash early. There's a very good mindset, right? It's not about hiding mistakes. It's about getting 100%, making 100%. So you want to make sure if there's something wrong, you get it immediately. And this documentation helps you to see whether the logic is correct. Right? And the other thing is just to see whether the translation to Python is correct. So here we have the price minus also the price, but there's an operator here, shift. So we will shift the price. If you play around a bit, you will see the price is shifted into the past. Given that our ordering is past on top, most current on the bottom. Yeah, so shift goes up here by 1 unit. And therefore what we're implementing here is exactly the formula here. Log st minus log st minus 1, and we call that here log return. Good. So now we have our return. Something you should consider is you apply machine learning to stationary variables, because you want to learn the stationary distribution. Now, prices are not stationary. Yeah? Something which is not stationary is something that might go to infinity. And if you look at the Microsoft price or look at the Apple price, I mean, these prices in 100,000 years from now, they will be, I don't know, but they don't converge across $100 or something. So therefore, we have to work with returns. That is something I didn't explicitly mention otherwise in the notes, but I just want to highlight why we work with returns is exactly, returns are stationary. And something stationary moves across a constant. So what we're doing here is now introduction to Python. So we are using the PLT package, which we did load in. It has a member plot, and now we are plotting the date on the x-axis versus the log return on the y-axis. And we get this beautiful picture here. Yeah? So Python is creating beautiful pictures. This is now very representative of financial time series. Have you ever looked at a return time series before? Yeah? Good. Some have, others don't. In this course, we will look at many time series. There's a lot to learn from that. Universal language, universal knowledge. And to the question of the one student with the energy, we're not focusing too much on the methods, but we focus on the data. And the data, if we don't have the Y label, could be anything. Right? So here's a pattern which is called, well, let's just describe it first. What do we see? We see there are periods where returns are really volatile, then they are calm, bit building up, and then we have a jump, we have crashes, then it calms down again, goes up again, and again it calms down, and there's a jump, and it calms down. This is called volatility clustering, a cluster. Yeah? Like this is a cluster of high volatility time points, this is a cluster of low volatility time points, a cluster of high volatility time points. If you are in such a high vol cluster, the probability that tomorrow is also high vol is larger than the probability of being in a low vol tomorrow. That's about clustering. Yeah? In machine learning, there's different ways to cluster things, but the overall logic is the same. If there's a pattern along which data groups, and for finance returns, very prominently we see returns cluster in terms of the dispersion the spread in their variation. Yeah, that's why we say variance. Although we don't observe variance directly, we just observe realized returns, but we kind of tend to think if there's a huge spread happening, then also if you compute variance in that moment, it's pretty high. Yeah, therefore we say this is high vol, low vol, high vol. We also see returns can jump, so most likely it means volatility can jump. If we trade options, we are interested in jumping volatility because it means your return can also jump. Now, what about quantities? Here we have the financial crisis. And we see during the financial crisis, not everything was bad. Yeah? Sometimes you also made 10% on a day. So we don't do causality here, but if I look at it carefully, it looks like it first went down and then there was a recovery. Now, it went down not just one day, but several days. Yeah? So it doesn't go directly to -10, but here you have -2%, then you have -5, most likely the next day. Then you have -9, -10, -9, -8, -7. Yeah? So then it goes back again. So how bad is a 10% minus return per day? I mean, it doesn't feel good. If you ever lost 10%, you can be lucky maybe that you didn't lose 20. But especially if you go with the futures and options and the like. But if you have an equity portfolio well diversified, like the S&P 500, where everyone says nothing can go wrong, just hold it, and you make 10% minus on a day, and the previous day you already made -8%. So it keeps adding up. That's why -40% during the crisis. And these were just a few days. It doesn't feel good, that for sure. Unless you were shorting the market, which we don't do in Germany, but in the US, I was 2008 in New York. I went to the IT department to get my computer. They didn't see me. There was a computer guy coming to the other guy. "Did you see the market? I'm short, what are you?" I'm like, aha, that's why my computer's not ready yet. So shorting the market is something very prominent in the US. 2008, it was forbidden in Germany. At least I didn't find a broker who does it. Now it's allowed, I think, but I'm not in the shorting business, so I don't have specifics, but I think it's possible. If not, we talk about futures, options. That's a way to also speculate or trade on your view. Okay, but what about -10%? There's a rule of thumb that on average, the standard deviation per day of a well-diversified index is maybe 1.5%. That's the standard deviation, that's the vol. Yeah, on average. Maybe it's 1%. I already make it a bit bigger. In this example, we will see it's 1.2. Now, another rule of thumb, we will learn it next week. For a single stock, you multiply by 2. Yeah, roughly. And why? Because diversification benefit in the index, but we have a full class on it. Now, if I tell you, let's say, the vol is 1.5%, or make it simple, 1%, so is that a Gaussian move here or not? If we have -8, -9, -10. It's not. Yeah? Gaussian move, everything within 3 standard deviations is okay. Yeah? So I don't get shocked if I have a 3 standard deviation loss. I'm like, okay. If I have it 2 times in a row, I'm like, okay, that's now not Gaussian. Because the likelihood of getting hit twice in a Gaussian density deep in the tail is pretty low. Yeah? So from that already you see returns are not Gaussian, independent of what the software will tell me. I just see it because it's not even one jump. It is boom, 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 boom. Yeah, so these were at least 5, 6, 7, 8 times like a 8 standard deviation event. Boom, 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 boom. So this is non-Gaussian. Why does it matter? Well, you should know the distribution of the data you're working with. If you do optimal decision making like portfolio choice, Markowitz basically assumes that returns are Gaussian. Yeah? Good. What you also see here, and this is also very prominent, I mentioned, but once again, volatility can also jump. Yeah, so if something unexpected happens, I don't have COVID here, but the same with COVID. Everything looked really great, and then suddenly sentiment turns, and you have boom. People are selling, volatility shoots up, and if you want to model that, you really need jumps. You need to allow your model to have these very sudden, abrupt shifts in the density. We will not do that with our models. What we will do is we will allow volatility to go up and down in a dynamic fashion, in the risk management section, which already is pretty good. But for pricing options, for example, you need to include these jumps. If you simply trade equity also for risk management, you don't need that. You can just do what we will do in the course. Good. Now, next thing you would do in an explorative analysis, you want to know kind of what's the mean, what's the volatility of your time series. Yeah? So that's what we're doing here. So within NumPy, also we have the mean function. So we give in the log return. You see how beautiful it is to read, because in MATLAB I would give you a column vector or something, which I always have to remember what's in it. But here I know log return, S&P 500. I just don't know the frequency, so that is what I need to keep in mind. But we checked with the data. Then I make a print, and I see the daily return is very low. So next thing by convention we do in finance is we are annualizing returns. And the reason is we have intuition, like the index vol per year is 20%. How come I said 1%? That's just per day 1%, but if I annualize it, it's like 20%. I have the annualization formula on the slide. And the same for returns. We kind of know on average, a very normal day or in a very normal year, I should earn 10% on a stock. Yeah. 10% on the index. Maybe 12 because I have 20% volatility around that statement anyways. So 20% plus minus 3 is 60%. So somewhere between 4% and 16% should be my equity return, which is true. Yeah? So this is kind of, and I'm also checking that here. So one thing I do is, where do I annualize the return? My annual return, what's the standard deviation? Annual return here. Yeah? The annualization is by the number of trading days per year. Sometimes people use 365 calendar days, sometimes 252 trading days. It doesn't matter, but you should know because it affects the results. But in terms of, it just affects the level. But in terms of time variation, it doesn't matter. So we go here with trading days. That's why you have a documentation. Yeah, that's where these things are mentioned. Now, more interesting is how do you standardize volatility? Because the variance is linear, but not the volatility. Yeah? The vol standard deviation is the square root of variance, and therefore the annualization here would be, you take the annual volatility, 1.2%. Where do I get that from? Here. I take my daily log returns. I use NumPy standard deviation. So that's my unconditional vol, and it is 0.11. I know that the returns were in decimals, so that's a decimal number here. So it's a 1.17%, that's why I say 1.2%. And I annualize that by multiply with square root 252. Yeah, so I get roughly 20%. So I know it was, the sample I look at was a normal sample in terms of the second moment, because 20% vol for the index is the normal thing. Therefore, you also see this financial crisis jump would not show up as being non-Gaussian if you simply look at the standard deviation. Because these jumps happen very short, very rare, and therefore it doesn't blow up your variance. But it will blow up your higher moments, kurtosis, skewness, and the like. And that's what we will see. Yeah, so therefore, when I annualize it here, I use a name, like I have the annual return, standard deviation, and then multiply by 252, and this is the symbol for square root, star 0.5. So I need to compute the Sharpe ratio. What's the Sharpe ratio? Theoretically, we see it next week. It's a measure of outperformance, because I see how much excess return, how much risk premium, if we connect back to evaluation, how much risk premium did I earn per unit of volatility, per risk. Yeah, so vol will be our risk measure. I assume just a risk-free rate of 1%. Annualized, therefore you see frequency is important because 1% is low, but per day it would be a lot. So 1% is all right per year. And so I use the annual return I earned minus the risk-free rate, and then I divide by the unconditional standard deviation, and I get my Sharpe ratio. As a rule of thumb, Sharpe ratio for the index is somewhere in the area of 0.3. Yeah, maybe you have a good year, it's 0.6. If it's 1.0, then this should be this very good. So then you should call me, yeah, and then I get invested. We tended to say if you want to open a hedge fund, you need to show Sharpe ratios of 2.0 and north. The Sharpe ratio in the machine learning paper I quoted, maybe 0.8 equity, right? So it's difficult to get north of 1.0. And at the very end paper with this robust reinforcement learning, no, we have one deep learning with convolutional neural net. And we have a master thesis now finished on it for options, it kind of confirms stuff. They produce a Sharpe ratio of 3, which is enormous, just with equity. So therefore, potentially there is something in finance data, even though we haven't yet found it with all these off-the-shelf stuff. This is before transaction costs. I forgot what his numbers are after transaction costs, but it would be above 1. And I showed it to a practitioner once in the executive MBA. He's doing performance measurement for a financial firm, and he said he never came across a strategy with such a high Sharpe ratio. So I think again, the day is ending for us, at least for me, lecture-wise. There's positive news that here and there we see new papers coming out who are really skillfully using machine learning to increase also these Sharpe ratios dramatically. But these are yet less than a handful of papers. The field is just starting. If you want to learn Python on your own, you could redo my calculations and, for example, double check whether anything changes if you use simple returns instead of log returns. Or whether if you use end of month returns instead of daily returns. Things will be slightly different, so that's an exercise if you want to. Otherwise, next thing I would just do is I check are returns Gaussian, so there's a Jacques-Barra test. And I gave you the intuition that the volatility will not be a good metric to tell me returns are Gaussian or not. We will work here with skewness. Yeah, there's a metric, skewness squared plus excess kurtosis to the power 2. With these loadings, gives you a Jacques-Barra statistic. And then you can ask the question whether the statistic is sufficiently low so that the data could have a skewness close to 0 and kurtosis close to 3. Basically, right? It's a joint test on skew and kurtosis relative to a Gauss. Who remembers what's the kurtosis of a Gaussian variable? 3. Very good. Yeah, so that's why we have here excess kurtosis. And what's the skewness of a Gauss? 0, right? Which you also see here. So we always take the sample skewness minus the Gauss one, sample kurtosis minus Gauss. So I'm doing that here. I use the SciPy package. And you see the SciPy, it has already functions implemented for skew, for kurtosis. I code it up and I ask for the p-value of my H0 hypothesis, so the probability that the data is really from a Gauss, and this will be 0. Yeah, there's a 0 probability that the data is Gauss. I got all of that already from the visual eyeballing. Because this gives a lot of kurtosis here. Skewness, I think, is rather symmetric because we see the crashes are symmetric, but the things are okay. Okay, maybe just to finish up for today, I can also, for Markowitz, we want to compute investment opportunity set. That is usually we need to compute expected return and covariance matrix. Right now we can only do sample averages because we haven't yet computed the analytics, as we will do moving forward. In the future, we can use machine learning to do all these things, but right now, just the sample averages. So we have here a bond fund and we have an equity fund. I gave you here the internet resource of the bond fund, so you can have a look. And what you see is that the bond fund, and this is my motivation for next week's class, the expected return on the bond fund, if you see equity 12%, bond fund is 0.1%, so nothing. Yeah, you hold bonds without any expected returns, but I claim you would still hold it. It's optimal. And the reason is in the covariance matrix. Because this is here the covariance matrix, have a look or recompute at home, and you see that on the main diagonal we have the variance, so the bond is also not risky in terms of movements, but the key is the negative sign here. We have a negative correlation between the bond and the equity fund. And therefore there's only one, you have 2 free lunches. If you read my website, I talk about 1 free lunch, which is the proper one people talk about. If you are 100% equity, I argue next week, you can reduce the risk and increase expected returns if you add a little bit of the bond. And this is like magic, because less risk, more expected return, that sounds like a fake. But it's not a fake, this is diversification. And diversification is it doesn't even have to be a negative sign, but if something is negatively correlated, it really means that if equity drops by accident, my bond does more by accident. So my volatility shrinks in the portfolio. Yeah, so my overall Sharpe ratio goes up. And therefore, it's very well known, even though we have an asset with a 0 expected return, if it diversifies risk, if it reduces risk of a portfolio, that's something we want to hold. And this will be the topic of next week, how to do that, or how to think about that. Good. Therefore, my last thing is, if you want to practice, good. Verify the code at home, play around with these things, yeah, and that way you get used to working with Python.